they will issue them stock, yeah. And sometimes, which we'll get to later, they give people the option to buy subscriptions to stock. So they're saying to their key employees, you can buy this stock today at this stock price, but he didn't have the money to buy it today. So, okay, that's okay. We're going to put a subscriptions receivable account, like an accounts receivable. Give it to him at that price, so many shares, and then give him time to pay it. And then later, it could go up or down during that time, but he's got it locked in at being able to buy it at that price. All right, so let's keep going. Par value equal to stock is issued for cash equal to the par value of the shares. Cash is credited to the capital stock account. Let's look at that entry. So these are kind of the entries you'll make if we issue stock. Common stock, in this case, they issued common stock and preferred stock. Common stock is just par value, the no benefits attached to it. Preferred stock, which you'll see when you read your chapters, has greater value because the preferred stock owners are guaranteed a dividend, which means each year, when they issue dividends, if they have good profit, they will divide up those profits and issue it out to their stockholders, a certain amount of it. And if you've got preferred stock, you get first choice, and a certain amount may be guaranteed. So preferred stock costs more, $100 a share versus $25. However, there are benefits attached. Then you just show cash, whatever we got for it, and then we enter in our common stock at the par value, preferred stock at the par value. This is when we sell it straight par value, okay? Sometimes if they give us something different, we talked about this, and I think you'll be very familiar with these kind of transactions because you just dealt with partnerships who did this, right? So what happens is, instead of the cash, it would show inventory, land, whatever they donated, and then it would show the value of the stock that they were being given. Okay? No big deal. All right, so here's our balance sheet for the corporation. Again, we've already encountered current assets, right? Total current assets, long-term assets. Okay, and then liabilities and owner's equity, current. And then your equity, you may have current or long-term. This company only has current assets, right? I mean liabilities. Stockholders' equity. And here we're going to show in our stockholders' equity the total amount of preferred shares that we issued, at what we issued them at. Par value, it means they're going to get 10% dividend if they pay dividends. 8,000 shares were authorized, so we set it up as how many shares were issued. Now you're going to have this note in here. This tells you in your balance sheet, it's going to tell you how many total shares are available to sell. Now you can't just, a corporation can't just go, oh, well, I think I'll issue some shares today and get some money coming in. That doesn't happen. This is set up in a corporation, the corporation document, and they say how many preferred stock shares they are making available, period, at this point. Now, they can later go in and get their board of directors or stockholders to vote to issue more, maybe. But at this point, when they're setting up, they have so many preferred stocks available. They have a total of 8,000 shares that were authorized by the company, by the board. And corporations are governed by a board of directors, not an individual. So, in this case, we have that many authorized, and here's how many we have issued. So we have sold or issued 1,600 shares at par value. So 1,600 shares times 100, this is the amount of value of those preferred stock. Same thing at the common stock. How many authorized shares? We got 40,000 that we authorized, so we can sell that many. And at par value, 5,300 shares were issued. Go up here and look at how much, $25. And you'll find the value of your common stock. So this is the only thing new that you're actually encountering right now. It's just how to set up your, instead of capital accounts, we have preferred stock, common stock. And we're going to show the number of shares we've issued. you sold. That means that's how many we sold. So the money for those, see, is included up here somewhere, right? In our assets, we used it just like we would have the money the partners had put in.
So now you don't do anything with the 10% on the deferred stock?
No. What you do, right. That means that they're entitled to a 10% dividend. Only if the company makes a profit and the dividends are declared. They would get 10% on, up to 10% for each share of preferred stock. And that's only for the people that own it. So if we let's say, okay, good question. Let's say if we declared a dividend, how much would we have to pay out or arrange? How much money would we have to have available for that dividend?
Would have to be 10% of the $160,000?
Yes. Right, exactly. Only of the amounts that we issued, yes. Right, exactly. And that amount would go out to the stockholders. All right, good. Okay.
Par value, though, they'd have to have all of it at the time that they issued any dividends to par value, right?
What? We've issued 1,600 shares, and that's the value.
Okay, I meant common stock. The only way that common stock would get it is if they issued any kind of a dividend on common stock.
No, yes. If there's any money left over after the preferreds are paid, and like they're saying we can pay this much out in dividends, the preferreds get their part first. If there's anything left, it is distributed to the common stockholders, just equally. You know, how to divvy it up, how many shares, how much is left, and that's how much comes. Exactly right. Yes, okay. Organizational costs, again, this is just another thing we covered in setting up a business. So organizational expenses are considered an expense. So you'll just set them up as total them all together and set them up as what you had to pay for these fees and stuff. That's a lot of. Okay, now when stock is issued for more than par value, that means it's issued at a premium. So we have another account called paid in capital in excess of par value. So what that means is our stock's pretty popular, and a lot of people want it. We don't change the par value on our records. The par value stays the same. However, people may be willing to pay more. For a $100 share of stock, they may be willing to pay $125 a share. So when you have that in your account, you have to set it up as part of it is par value paid in above par value. The other just goes on the regular line where your stock is issued. So there's a separate account. Okay, so in this case, we issued 400 shares of that preferred stock, right? At $100 a share, that would be the par value, right? So that's the value we can put in here as preferred stock value. But they paid $5 extra. So we got another, what, $2,000 that they paid in addition. So we're going to put that in our paid in capital in excess of par value. It's just another capital account. That's where we keep up with that one. It's not added to the value of the preferred stock account. It stays at par, number issued, par value. And then the cash we get would be $42,000. Okay. And so this is going to show up down there as another capital account. All right. If it doesn't, stated value is assigned by your directors and the charter issues how much. If you're issuing no par value, then it's whatever you get for it at that time is what you record as your value. And usually a stock certificate's not going to show a stated value. It would just show you had that share of stock. Whereas when they state it, it'll have on there one share of preferred stock, $100 par. It's not stated. It doesn't have a par value. It's just issued with not a value on it. Okay. You'd have to go back and look at your charter to find out how they set it up. Lots of times they just set it up as $1 a share normally when they start in the auction. But the rules, and y'all can read through this. I'm not going to read this to you, but the change requires revision. They have to go back and revise the charter. Any changes have to go back to the board and have to be revised and have to show up in their charter, a document. So it's a very legal type procedure. Okay. Because sometimes you'll find they do different things, but anyway, well, stated value wasn't assigned. First issue was for 1,000 shares for $20. So since it didn't have a par value, we just say, okay, cash, we got $20 a share for this one. Some people bought it. So it would be cash, 20,000, common stock, 20,000. Just whatever they could get for it. Second issue, see what happened? $22 a share they sold this for. Stock's going up on the market, they can sell it some more. And if they have no par on it, they have to fool with the what? The paid in and excess par. Okay. So it's not tricky or anything. You just have to remember if it's par, you do it one way. If it's not par, and you'd have to deal with the premiums. And all of it goes right straight into the stock account. As you sell it, just for whatever you got for it, in other words. Okay. And in this case, we did have a par value, and this is just showing you the difference and how you deal with it. And they got $26 a share instead of what the par value was, which was 25. So in this case, you can only show the 25 par on your common stock, and you have to show the extra dollar is going to have to show up in that paid-in capital in excess of par when you make your entry. All right. Okay, everybody cool with that? It's not hard. It's not. I mean, you can go back and it's pretty straightforward. I don't think nothing we have to do formulas for on this one, right? Okay, subscriptions means, and I talked to you about it already. Gives you sort of a payment plan. Stockholder pays for the stock later. He gets it at a certain price, signs a contract that he's going to buy it, and he receives his stock certificates after he makes the payment. So, but we still have to show that he's got rights on that stock, so we have to set it up in our books. So we have a subscriptions receivable on common stock for $10,000, and it's subscribed, give the person's name, and he's going to buy 400 shares at the agreed price of $25. Pretty good deal for him if the stock goes up to 30, right? He still gets it at 25. He could turn right around and sell it and make a profit. Okay, everybody with me? Yeah? Okay.
I think so.
Subscriptions receivable, sort of like accounts receivable. It means they're just going to, okay. All right. And then when he pays for it, same way we deal with any kind of receivable, accounts receivable or whatever, you just show, okay, cash, and credit to his receivables account, which would be, instead of accounts receivable, it's subscriptions receivable. And then we're going to go down here after we get rid of his show that he paid for it. We're going to set it up, take it out of the subscribed account where we had to put it to hold it for him, and go ahead and put it in, show that the common stock was issued, and put it as common stock. Okay. All right. There are many things. The rest of this is more details about corporations, how they're set up. You are responsible for looking at it. They have to have minutes. They have to have bylaws. They have to issue certificates. They have to have their stock ledgers. In other words, a list showing who all owns stock. You have to keep up with all that, just like you would your accounts receivable or your owner's capital accounts. Each one of them is a separate account. Okay. Even though we lump them all together on our statements, over here in the book, we got every single person, even if they only own one share. Okay, so that's where we keep up with. And these are, okay, that wasn't hard, right? Not hard?